Everybody. Thank you for spending some time with us this Tuesday, December 9th, 2025. Kind of,
Look,
rounding out
people are
the
coming
year.
from all over the place here. We've got
There we go.
Denmark. We've got Portland, Oregon. We've got Kuwait, Bavaria, Dallas, Cape Town. Look at that.
What an international audience we have. That's one magical thing about the technology like this, right?
Yes.
We get to click a button from our living rooms and we get to talk with people from all around the world. Well, thank you
Totally agree.
guys so much for joining us today. We will do everything we can to make the next hour of your life worth the time investment that you are going to be spending on it. Today, we are here to do a deep dive into a very popular stock that is a product that I think everybody here has probably used or come across with. But
Definitely very familiar with.
Yeah, and I believe, Stovall, this is a stock that you owned at one point?
No, I still do.
Okay.
It's one that is sitting in the. So Brian, just a little bit inside baseball here. Every 6 months, I kind of do a 360 of like reevaluate the anti-fragility, the valuation, everything, and I'm doing that with Uber right now. And there's so many question marks.
Got it. We were not live on all the platforms. Weird.
Well, I do see that.
I'm clicking go live right on each of the individual ones. Okay, there we go. That should be working. Yeah, thank you. Okay, sorry about that. We only had a couple of people in here, so thank you. Great to hear that. So welcome everybody to today's deep dive. We're going to be diving deep into a very popular stock, and Mr. Stoffel is a owner of this stock. So let's get going.
Hey, for what it's worth, Mr. Feroli, when I checked, I could not see anyone in the YouTube stream. Like I couldn't see it showing up as being actually going on.
Well, technology, we are still getting used to this new platform. So if we screwed something up, we are sorry, and we will get it there later. But with that, let's go ahead and start. Let's start the process. This is being recorded. So what stock are we doing today? The answer is Uber. On last Wednesday, we sent an email out to our newsletter subscribers, which if you're not subscribed to, longtermmindset.co. We asked, which of these four stocks interest you the most? Uber got 41% of the vote. Airbnb was only 23% of the vote. So that's what we're going to be researching today. So we would love to know from viewers watching here, do you own this stock? Do you own Uber right now? If you could let us know in the chat, we would be happy to tell if we're talking to Uber shareholders, prospective Uber shareholders, Uber haters. We would love to know what your thought on. I do not own Uber stock. When they came public, they were setting fire to money like crazy. I do know that situation has completely turned itself around, though.
Yeah, completely. But I don't think you're alone. You know, Omar doesn't own it. GS doesn't own it. Mark doesn't own it. However, we've got a whole bunch of people in here that do own it. Yvonne, and interesting, some people are saying, yeah, they're playing with it, you know, with options around the underlying stock and things like that. So I guess if I had to say, it looks like maybe 40% of the people that responded own it.
Fair enough. And for those that don't know, my name is Brian Feroldi. I've been investing in the stock market for about 20 years or so and beating it. So has Mr. Stoffel here. We are firm believers that the reason that we've done well is because we know how to do the research. That research builds conviction in companies. That conviction enables us to have patience, and that patience enables us to buy and hold through the inevitable downturns that come our way. Now, Uber came public in 2019, so just before COVID, kind of had a rough start to its life, has been up and down. But recently, in the last 18 months, this has been a sensational holding. And if you bought at the IPO, you've doubled your investment just in a couple of years. So, and again, step one here is research. So that is what we're going to be doing. We're going to be doing research. Now, how do you do the research? How do you research a stock from scratch? We are going to be using our favorite way of doing this, a product that we built called Stock Simplifier. There are 7 different steps to Stock Simplifier: the business growth cycle, the business model, the moat, the growth levers, risks, key metrics, valuation, and more. If you're unfamiliar with it, we are going to go fairly fast through this process. If you are a paying member of Stock Simplifier and you have a question about one topic, we have the courses and everything in there. We have the tools and we have the prompts. Everything is included in the Stock Simplifier package so that you can do this on your own. But Brian, we recently rolled out a new AI prompt.
Yeah, I like this. So we made a new prompt that basically just says, hey, what is the sentiment around Uber? Now, Brian, you and I are not sentiment driven investors. However, I do think that it's worth looking at. If nothing else, I think it's interesting. And Brian, just real quick, I see that in the past, we've just done ChatGPT. This first one, we're going to do Grok. Do you want to explain why we use Grok?
Grok is probably the best for sentiment analysis because Grok has the most real-time conversation. Like Grok is so focused on real-time conversation since it's built on top of X. So we're going to run the sentiment analysis in Grok, and this is going to let us know. So let us know what investors are thinking about or talking about on X about Uber.
I think you.
I typed. I did.
Grok.
Yep. Try again, but with Uber. I typed the wrong thing.
Hey, but Grok knows what it's doing. It immediately did Tesla.
Yeah.
Based on Grok.
Okay. So this prompt looks at the last 1 year. It looks at the fundamentals. It looks at the what the stock has done, and it gives you just like what is the current sentiment that is surrounding holding Uber's stock?
If I had to guess, I would just say altogether as middle of the road as you could possibly be.
Okay.
That's what my guess would be. Grok can access way more information than I can, but that's what I would guess.
Okay, here we go. All right. So the overall takeaway, Uber stock has gained from consistently beating earnings, 20% trip growth and AV partnerships with autonomous vehicle partnership with Cruise and WeRide, boosting bookings and free cash flow, but pulled back late year on Waymo expansion fears and Tesla robotaxi hype, resulting in a 39% net rise year to date. Okay, the next catalyst is in February of 2026. Autonomous vehicle deployment updates and partners. The 12-month outlook is bullish. Let's see. By analysts are bullish, investors are bullish. The media is mixed. So sentiment is built on profitability milestones. Analyst ratings, 32 analysts have a $109 price target. That's 20% higher than today. Institutionals and ownership with positive free cash flow supporting buybacks and inflows. Discussing. So this is all about the autonomous vehicles.
I mean, that's everything.
Totally makes sense.
What's going to happen with autonomy? That's the biggest thing.
100%. So the bulls say 20% year-over-year percent growth in trips and adjusted EBITDA of 1.7 billion. A terrible profit metric, but at least shows it's a positive number. The autonomous vehicle integration with Cruise and WeRide, and a $7 billion. Are they buying back stock?
Oh yeah.
Wow. Okay. So they're buying back stock. Well,
it's tells me it's a huge company though. So even though that $7 billion is great, we're talking about, I'm checking right now what the market cap is. I believe it's at least 150 billion.
All right. So that's like 2%.
No, it's almost 200 billion. So it's like,
okay,
still 3% isn't bad, but it's not quite as good as that number makes you believe.
I would also think they have better uses of $7 billion to defend their business. But okay. So when Waymo's independent Miami launch raises fears of disintermediation. Ooh, so Waymo is detaching from Uber. The stock dropped 9%.
Nobody knows what's going to happen. Like in some cities, Waymo partners with someone else. In some cities, Waymo partners with Uber. Every city is different.
If I was Waymo, I would want to partner with Uber to get myself off the door, out of the flow, and then do exactly like they did with the phones, basically, is build their own platform, right?
Sure. And then, you basically use Uber, and then as soon as they can cut themselves loose.
All right, so that was at least a decent overview of where the company is today and what investors are thinking at. It did identify that autonomous vehicles are on a lot of investors' minds, mine certainly included. All right, so moving on. Now we need to figure out, before we can analyze it, which of the 6 stages of the business growth cycle is Uber currently in. So why don't we ask the audience here, what phase do you think Uber is in? If you had to pick one of these 6 phases to analyze Uber stock, which one is Uber currently in? So if you could throw in the chat, in the comment section, which phase you think Uber is currently in.
So we got Dave saying 3 into 4, Nick saying 3, Karsten saying 4. Remember, it means that it's got to be profitable. And if you're in stage 4, those profits have got to be growing faster than revenue. We've got a couple 3s, a couple more 4s. Someone said 2 to 3. A lot of 4s.
Yeah, a lot of 4s.
A lot of 4s.
4s do seem to be the consensus here.
I actually believe we're at mid to late 4. That'd be my guess as a shareholder myself.
Okay, well, let's have
now. I believe, are we going to use Gemini this time?
Yeah, let's use Gemini. I've heard so many great things about Gemini. And,
I've switched over completely.
Yeah, I haven't used these prompts personally on Gemini, but let's see how it does.
Hey, we can troubleshoot real time.
There you go. There you go.
Brian, we've got thousands of people joining us. This is great.
Awesome. Thank you. Thank you for joining us. I'm just glad that the technology is working.
Knock on wood. You say that, and then Gemini is going to go out on us.
Exactly. All right. So we are running this prompt in Gemini. And what does Gemini say? So Gemini says it's a value stock and it's currently in phase 5.
Now we're going to talk a little bit about how you made the prompt, because I think that'll help people understand why it says that.
For sure. Confidence level. It's very highly confident in this answer. Now, why? Because operating income is positive figure. That's a good sign. Revenue is growing 20% per year, but this is the big thing. Capital returns. Yes. It initiated a $1.5 billion accelerated share repurchase program in 2025. So that is a really good indication that the company is in phase 5 when it's been buying back stock or returning capital to shareholders. So because Gemini says phase 5, it says the most important valuation metrics to look at are price to earnings and price to free cash flow, perhaps a reverse DCF, and they fit because the company is mature with stable operations. So now, there's some details and there's some links. Great.
Brian, a little bit of inside baseball real quick. When you and our friend Justin were working on these prompts, you guys have to make hard lines for the AI to make a decision. Is that right?
Correct. Yes.
And so giving some type of capital return is like one of the hard lines that you do.
Well, imagine this. So these are obviously very squishy, right?
Yes.
So
absolutely.
how do you distinguish between phase 4 and phase 5? What we program the prompt to do is the line is, are they giving capital back via dividends or buybacks or not? That's the delineating line. Just like with 1 and 2, the delineating line is, are losses increasing or decreasing? Right. That's the line that we chose.
For what it's worth, revenue growing about 18%, operating profit growing about 70% on a trailing 12-month basis. So I would still say stage 4, but I don't think it makes that big of a difference either way. We've got the general ballpark correct.
I would also probably stage 4, but like you said, I would say late stage 4, early stage 5. It's kind of splitting hairs which ones it's in between, but technically the AI did the right thing because it chose their returning capital to shareholders. But for the sake of this argument, I'm personally going to say it's phase 4.
Yep.
So I'm going to open up a new cheat sheet. I actually haven't done that yet. I'll get that going. All right. So we're going to say it's in phase 4 for that. Okay. Next, we got to figure out, okay, how does Uber make money? What is its business? What are its key products and services? Where does it operate? And what are the qualitative metrics that matter? Like how often do customers buy and stuff like that? Oops, I clicked the wrong button there. Let me get a new fresh copy of this sheet going. So to figure that out, I'm going to go to the AI prompts. I'm going to go to the business analysis. I'm going to go to Gemini and I'm going to paste that. And we're going to run this prompt and it should be able to fill. Oh, that was nice and quick that it came back to. Now, why that prompt is running, I'm going to close down the cheat sheet. I keep clicking the wrong thing.
Hey, Brian, real quick, while you do that, I just want to show Mark asks if the sentiment prompt is in Stock Simplifier. It is. If you bought Stock Simplifier, it's at the bottom. It's the last one.
It's right here.
Yep,
it's right here. So here's the kind of prompt database that we have. It's that new prompt we built there is right there for you. Here is the spreadsheet tool. We're going to go here. I'm just going to quickly fill this in. Uber. There's a link to fiscal. We'll pull that up. We're going to choose phase 4, even though the AI prompt said phase 5. We kind of said
it
that
did the right job
there. Yep. And we're going to be using it on there. So this is what we're trying to figure out is the business description. Okay, so we did that. So Uber for the year ending December 31st of last year. So what does the company do? Uber operates a global technology platform that connects consumers with independent services for various movement needs. It has 3 offerings: mobility, connecting consumers with drivers for rides in cars, taxis,
auto rickshaws.
Delivery, consumers
Uber
to order. See what?
Uber Eats.
Uber Eats, groceries, alcohol. It's really Uber Eats and Instacart, kind of.
Yeah, it kind of is. These days, it has been changing. I agree with you.
And then there's freight, which is connecting carriers with shippers.
Which
so
I
just
think
you need
a dying business for them.
Well, we'll look at that in more detail. Okay, how does it make money? Uber generates by collecting a service fee from the gross bookings of trips and deliveries facilitated through its platform. Advertising revenue also contributes to the mobility and delivery segment.
Brian, we met up in Orlando last week, and I noticed this. I had to take, because I got in so late when I met up with you guys, I took an Uber from the Orlando airport to where we were staying. And there's like a very teeny tiny iPad strapped to the seat in front of me, and it has ads playing right there. And on the app itself, there was ads.
All right. So those are not broken out separately. They're currently in delivery and freight, it says. And that's where it got that source from. And it says, here's the split. Mobility is about 57% of revenue. Delivery is 31 and freight is 11.6. Okay. Who are the customers? The customers are 3 groups. There's consumers, those that book rides and order goods, 156 million monthly active platform consumers, MAPCAs.
And that's at the end of last year. So it's probably even bigger.
Driver and carrier side. So the independent contractors use the platform and earn the income by providing that services. And then merchants and shippers, which are businesses, including restaurants and grocery stores, who partner with Uber to sell goods and move cargo. Great. Where does it operate? Okay. Technology is available in more than 70 countries and thousands of cities, highly global, but 62% of revenue is US.
To me, this is it's US and Europe. I feel like Uber tried in a lot of other geographies and had trouble, and instead bought stakes in the leading providers in those places, like Grab in Southeast Asia.
So let's talk about that for a second. This business, by its very nature, is very much winner take all. Right? Yeah. There should be one dominant provider of rides because of the network effect, where you want the most availability of rides, and riders, the biggest platform attracts the ones with the most supply side. So if you're not number 1, or at very least number 2, you're not going to exist.
Yeah,
pretty much. So if they couldn't establish themselves as number 1 immediately, I think that with Grab, they pulled out of the market and then got an equity stake in Grab, if memory serves.
Yeah, and Tony points out Latin America is an area where they have an in.
Oh, great, perfect. So fairly that would be rest of world, but good to know.
Yeah.
Okay. How often do customers buy? Customers engage in highly transactional, are frequent. So the core business relies on repeat usage instead of long-term contracts. The platform recorded 11.3 billion trips in 2024, reflecting high volumes and the recurring nature of consumer use. Consumers generally purchase services multiple times per month, as evidenced by the high number of overall trips relative to the total number of active monthly users. Yeah, 11 billion trips and 100 million people. That's a lot.
And I don't know. Did you ever see the movie that was put out on the founding of Uber, Brian?
No.
It has Travis Kalanick going around, the founder of Uber, and asking for people to invest in the company. And the thing that he says over and over and over again, they ask him, how many trips until they become lifetime users? And do you know what the number was?
3?
2. He said, if we get someone to use Uber twice, they're with us for the long haul.
It makes sense. That first one is very nerve-wracking. The second time, you kind of build some confidence. So that makes sense to me. I'm an Uber user, and I don't even have Lyft on my phone.
There you go.
Okay. Can it raise prices? Pricing power is generally constrained by intense competition for mobility, delivery, and logistics, which are characterized by low barriers to entries and the presence of well-capitalized alternatives. The company states it must continue to offer incentives, discounts, and competitive freights to attract and retain users, with its limits ability to raise prices. The company demonstrate and improve its revenue margins, which is driven less by price hikes and more by generating cost leverage from higher volumes. So kind of, can it raise
I mean,
prices?
it's
Kind of.
tough. It's where that lift being there is important just for us as consumers to keep the prices down. That's hard. And we'll get to a little bit later. It's going to become even more murky when we're thinking 5-10 years into the future.
Potentially, right?
Yeah.
So what happens in a recession? The company's performance is sensitive to economic conditions, but its business segments are affected differently. Mobility are tied to consumer discretionary spending, which could decrease in a severe downturn. However, it provides flexibility for drivers to generate income, which could increase supply, potentially driving down costs.
Makes
okay.
sense.
Freight, this segment is highly cyclical and directly exposed to the broader freight market. And then historic note, the company's 2020 revenue declined significantly due to COVID. Let's hope COVID was a once in our lifetimes situation there. But yeah, I would say that would be accurate. So one thing I'm not loving about Uber is that you can't click the link. Gemini is you can't click the links
Good point.
You can in ChatGPT. So I'd say that the results have been really good. But
for what it's worth, we did have someone point out that, do you see that little arrow? I don't know if you want to do this, but you can change it from fast to think. It's up to you. It takes a little bit longer.
I prefer fast.
Yeah, that's fine. When you do this on your own, you can do the think if you've got more time. We don't want to make people wait there and watch us.
Yeah. So how often do consumers buy? I have no problem saying recurring. Can it raise prices? I'd say it's somewhere between can increase and would lose customers right now. And what happens in a recession? I would call it normal. Personally. So what do our viewers think? Red, yellow, green. Is this an attractive business? So red would be, I still don't get what this company does or how it makes money. Yellow would be, I understand, and it's okay. Green, this is one hell of a good business, and I fully understand it. So we very much tried to optimize for, again, simplicity, stock simplifier, and red, yellow, green is a way to go. So what are people saying?
We've got Martin, Elaine giving it green. We've got Robert giving it a yellow. Albert and Miguel give it green. We've got a not sure. I would say green with a tint of yellow is pretty much where we are right now. We do have some very interesting questions up here, Brian, which I know is the next thing we're going to do. Like Tariq says, extreme price competition contradicts the company having a moat, doesn't it? Please comment. It's almost like we planted him in there to lead us to our next section. But what do you get?
So we're going to talk about the moat next. And I think that the pricing is going to depend. Assume that autonomy didn't exist. Assume that was not even a thing. Assume that Uber existed in the 2010s, right? And autonomy was literally a 15 years out thing. I would say this company has great pricing power.
And why?
I would say,
why would you say that?
Because the only competitor that I can even think of is Lyft in the U.S. At least, and it's by far and away the number one. Given that Lyft is a viable alternative, at least in the United States, and I'm sure there are competitors depending on regions, area, and the looming threat of autonomous, I would say that a company can still have a moat, but that moat has questions in the air around it. But we're going to get to that section. It's
not black or white, too. It's not, yes, there's a moat, no, it's like how strong is the moat? And
what's the direction of the moat? The direction of the moat, I would say, is even more important than the absolute state of the moat. But I think for right now, it's fair to say that this is an exciting business from what we've learned thus far. By the way, if you want to use Stock Simplifier, it's normally $199. If you use the link that Mr. Stoffel is going to share in the comments section below, depending on what platform you're watching this on, $99 if you want to get it. If you want to get everything that we're using so far. Okay. Next section is that moat section. So is this a red moat? It's there's no moat or it's weakening? Is it a yellow moat? It's narrow or it's stable? Or is it green moat? It's wide and it's expanding. So there are 5 different sources of moat: network effect, switching costs, low cost production, intangibles, and counter positioning. Then we want to know, okay, what's the state of the overall moat of the business? None, narrow, or wide. And what is the direction of the current state of the moat? Is it shrinking? Bad. Stable? Or widening? Great. So to figure that out, we're going to first ask people, what do you think? If we said, what was Uber's primary moat? What source do you think is the primary moat?
You're talking about that top row up there.
Yeah. So which of the 5 do you think is Uber's number 1 source of moat?
I mean, I know.
If you think it has multiple moats, which do you think is the strongest and most important?
Mark says network effect, where each user that joins makes the platform more valuable. David says network plus intangible, and I'm guessing with intangible, he's saying the brand value. Elaine, networking. Casey, networking. Network. I think we've got a pretty clear answer here with the network effect.
All right. So that's what people say. Let's say if AI agrees with our analysis that it is the network effect.
And again, think about it. Every person that joins as a rider attracts more drivers. Every driver that lists there attracts more riders, and so on and so forth.
Or the value of the network increases for all existing players based on new people joining. Okay. So Gemini says the current moat size is narrow. The current moat direction is widening. And it says the primary sources are the network effect and low cost production. Okay, Uber possesses a narrow economic moat driven by the sheer scale of its global network effects, which are strengthening as the company successfully cross-sells services and achieves meaningful operating leverage. This is evidenced by a 33% year-over-year increase in adjusted EBITDA to $2.3 billion, confirming the platform's ability to monetize its growing user base. Okay. Switching costs. Present, it says, yes, switching costs are there, but they are narrow and they're widening. Switching costs are present, but not insurmountable, primarily manifesting from the Uber One membership and the stickiness of its cross-platform users. While consumers can easily switch apps, those who use mobility and delivery services are highly valuable, creating friction to leave the ecosystem.
I want to hit on this because someone on LinkedIn says you can't be serious. Passengers and drivers will switch to an alternative option if it's 10 cents cheaper. Here's the thing about that, though. Brian, how many ride-hailing apps are on your phone?
1.
So how often are you checking to see if it's cheaper on Lyft?
I use Uber a handful of times per year, so I'm not a regular recurring user. If I lived in a city center without a car, I can see myself being more price sensitive and more shopping around, especially if you can load them both quickly and do a quick price test. Because I have heard in some situations there is a sizable price difference depending on which one you go towards.
Sure. And so
what about you? You're in more of a city center than I am.
I have a car. I live in a walkable community. I literally use it when I go to the airport and when I come back. Like, that's it. And
okay, but do you check 2 places or do you just go to one?
These days I just go to one. And it is Uber.
There you go.
And the reason it's Uber, to be clear, the reason it's Uber is because I use Uber Eats. And so I've got that's why. I mean,
okay,
that's it.
There you go. So I would say I agree with the comment that it's easy to switch apps, but that does require installing another app, setting up a profile on another app, and then flipping back and forth. And it's a time investment. So it's not huge, but it's not nothing.
Sure. And we've got plenty of examples here of people who say I use both, but I do think, and Casey brings up a good point. If you want a fast response, you're gonna just use your preferred, whether that's Uber or Lyft. But that's why Uber One is so important.
Yep. There you go. Uber One. And it says Uber One has 36 million members. I assume that that's a subscription where you get more rides, discounts and stuff for paying a monthly membership.
Yep.
And they say cross-platform consumers like you that use 2 things are 35% better at retention. And we keep deepening our engagement from single product users. Okay. Intangibles, the brand name, narrow and stable. Uber's intangible assets are derived from its proprietary database, its global network, which feeds sophisticated matching. Yep. Although Uber brand is globally recognized, competition prevents significant pricing power. Right.
Can you just talk for a second? What you always say about Delta.
Yep. So there's brand is actually, I learned this recently from Alex Hormozy, who said it kind of brilliantly. The brand does a couple of things for you. One is that you know what it means. If I said Delta Airlines, everyone here knows what Delta Airlines means. But a brand is only a powerful intangible asset if it causes you to change your behavior. Right. So if you're shopping and you see an HP computer, an Acer computer, and an Apple computer, and you are specifically choosing the Apple because of the brand name, or even willing to pay a premium for the Apple, that's a strong brand name. Whether you just recognize the name, if it doesn't cause you to change your behavior, it's not as valuable as just knowing the name of something. Another way that it's valuable is if I said to you, name a ride-hailing app. Right. And if you just said Uber off the top of your head, that's consumer mind share. There is something to that, but it's most powerful.
Not the same.
It's most powerful when you use that mind share and you know the name and it causes you to change your behavior.
Exactly.
So that's how the pairing comes together. This one does have some nuance to it. I will say that I would give it partial credit here. I know the name Uber. It would not cause me to. Well, I use Uber on my phone. So middle of the road here. I'm going to say narrow and stable. That makes sense to me.
Yeah.
Right. Network effects, wide and widening. Mobility and delivery operates a powerful two-sided network effect that serves the company's strongest moat source. More riders means more couriers, which leads to lower wait times, and in turn is more riders. This virtuous circle is strong in dense areas where Uber is the market share leader. The accelerating user and trip growth gives it a wide local weighting, and they have monthly average platform consumers grew 17% to 189 million.
That's really impressive for as long as Uber has been around.
Yep. Monthly active couriers reached 9.4 million. So this is people that are delivering. Our strong user base reinforces Uber's network effects. Okay. Low cost production, narrow and widening. Uber's cost advantage is derived from its massive scale. Company can spread significant fixed costs like technology, customer acquisition, insurance, and regulatory compliance across 3.5 billion quarterly trips and 50 billion in gross bookings. This is a structural advantage in the lowest per trip cost basis globally. What do you think about that?
I'd have to dive into that. I'd never really thought about like its scale allows, because they're price takers, which, is great. I don't know. What do you think about that?
I hadn't thought about given the scale and their like advertising expense and their R&D expense over just a larger pool. I can see that giving them a couple of bucks or maybe a couple of cents of low cost production. So
yeah, it's not huge.
It's not nothing, but I wouldn't say it's counter positioning. So counter positioning is, I would say they absolutely
that's how they got off the ground
against taxis, right? Completely different business and business model than taxis with the app and everything like that. But taxis are now like the entire taxi market is like teeny in comparison to just Uber, the company. So this is not counter positioning was the first moat that the company had and used it to grow into the behemoth that it is. But this moat kind of is self-defeating really.
Well, we've always said it's it has a short half-life of a moat.
It's if you're looking at a phase 1, phase 2, or phase 3 company, though, sometimes it can be the most important moat to look at.
Yeah, absolutely. Because it gets you off the ground.
So what are some risks? Uber's ability to maintain its low-cost structure is highly dependent on classifying drivers as independent contractors. The company has had a ton of legislative battles. Autonomous vehicles remain a major long-term uncertainty. Uber faces domestic competition from Lyft and DoorDash. So, as well as significant international competition from Grab and Didi. The market remains highly competitive, often forcing to use price and incentives to maintain supply and demand equilibrium. If that is the case, then the company does not have pricing power at all.
No. Although I would argue for them, if we look up their free cash flow figures, they're not hurting right now based on that.
But for what it's worth, Morningstar agrees with everybody here. Narrow economic moat, narrow network effects, and intangible assets. Now, let's talk about network effects for a second, because there are different stages of network effects, right? I got busted in the past by investing in Grubhub. I thought the company had amazing network effects because it was the leader at the time. DoorDash blew Grubhub out of the water. So what I've learned the hard way is that with a business like this, there are network effects, but they're hyper localized.
Yep. In Rhode Island joining Uber, correct, or if you start driving in Rhode Island, that doesn't do anything for me in Wisconsin.
Nothing for you in Wisconsin. Now, if I visit Wisconsin, I want the network company that has a network effects in Wisconsin or in Seattle or in San Francisco. But just because somebody joins in Rhode Island does not increase the network effect for you in California or you in Seattle or you somewhere else. So there are network effects, but it's more a collection of hundreds of small network effects than it is one mega network effect.
Agreed.
That's a really important distinction to keep in mind.
Agreed.
So if they lose in one city, if they lose in one city, everybody in that city loses out on them. So I'm going to give them credit for the network effect. I will say that, yes, the company does have a moat. I'll go with narrow. I would say more narrow moat. You could argue it's green, but I'll go narrow just for the sake of conservatism there. But that's an important thing to keep in mind.
Casey's got really jokes here, just showing Casey. She's surprised that we've got Uber in Wisconsin.
There you go. Okay.
Or he.
Great. All right. Up next, growth sources. So what is this company's long-term growth potential? Now, there are two ways that a company can grow. It can get new customers and it can get existing customers to spend more. And they're kind of our subcategories to each. Now, one shortcut trick is to go to fiscal, type in the company's ticker symbol, go down to growth. And this is a company that's growing revenue, call it 20% per year. And over the long term, earnings are expected to grow 31% per year.
That reaffirms the phase 4 that we gave it to me.
Yeah. That's really fast growth. So that is what the market is estimating, or analysts are estimating, is this company's long-term growth rate. Now, why? Why should we believe that is what the growth rate is going to be? Well, that's where this prompt comes in. It breaks down kind of each of the two growth sources to see which subcategories will drive that long-term growth. So let's see what Gemini says here. Okay. Getting new customers through marketing and sales. This is a big growth. Management is moderating margin expansion to invest in growth opportunities. Sales and marketing expenses were 3% of bookings, and that was up. So
I believe if they're still growing at double digits, I believe surprisingly that there's still a lot of room for growth.
Great. So just making people more aware of Uber. New distribution channels. So mixing in integrating mobility and delivery, and Toast for restaurants. Key partnerships with Toast and NVIDIA. Interesting. Okay. Geographic expansion, very strong. Focused on unlocking lower density market where growth is yielding 1.5 times the rate of denser markets. So they're moving out to the suburbs.
And to be clear, the main reason that they are, I think, experiencing a lot of positive momentum there is because no one else is focused on those areas usually.
There you go. Acquisitions, weak.
Yeah,
acquisitions are not a major growth source for the company. Okay. How about existing customers? Pricing power, weak. Management states pricing remained relatively flat and keeping prices as low as possible. What about new products or new services? This company does have a history of rolling out new products and services. Witness Uber Eats.
Yeah.
What a great innovation, a needle-moving innovation for the company. So local commerce has a $12 billion gross booking run rate, autonomous vehicles. So that's an opportunity for them. Retaining customers. This is a strong focus to get more.
I mean, this is where Uber One comes in too. where
Yep.
you retain more customers if you get more people signing up for Uber
Oh,
One.
for sure. Yep, that's a great one. So the biggest growth are new products and services, retaining customers, and investing in sales and marketing. The second biggest growth are geographic expansion and new distribution, and acquisitions are not a major source. So what do people think?
One thing I would just throw in there too is a lot of it comes from volume growth, but not pricing growth, which
Okay.
is a trade-off, right? But yeah, tell us what you think about their growth prospects. Green, they look great. Yellow, so-so. Red, I'm not sure how much growth that they have left. I'm curious what folks have to say.
Yeah, me too. Yeah, let us know in the comment section. I'm also curious what you would think of their growth potential. And again, this is just on what we know so far. If in the back of your mind you're like autonomy and stuff like that, that will come up in the risk section.
I mean, that I'm going to wait for that section, because to me, if there was no autonomous risk, I would say green. We've got a lot of yellows here. It's just one of those things that I have no way of imagining with any certainty what it might be like. But I would say, in much the same way, we've got some yellowish green. I agree with Robert, though. 17% growth in monthly active platform consumers. I mean, that's not nothing.
Mix in the operating leverage too that we're about to come across, right?
Yeah.
So that is I'm going to go green. Witness the 31% estimated earnings per share growth rate that the company has put up. 31% is very fast for a company that is already profitable and at this size and scale. So I'm going to say great, with the massive caveat that autonomy could blow that up. But again, we haven't kind of gotten to that section as of yet. So that's what people think. Quick reminder: if you're watching and you want to get access to Stock Simplifier for $99, Stoffel will share the link in the chat. Okay. Next, key metrics. Now, the key metrics, this is my favorite thing about Stock Simplifier. The key metrics that you need to look at change depending on which phase of the business growth cycle the company is in. We chose phase 4 for this. So the metrics to look at are revenue growth on a 3-year basis, the operating margin, the free cash flow margin, earnings versus estimates, and return on invested capital. Now, looking these up using Fiscal is fairly straightforward. We did build an AI prompt to kind of to do these for us, and this is the prompt that the AI struggles with the most.
By far.
But let's give Gemini a chance.
First try.
Yep, and see how it does.
All right, Gemini, you don't get a second chance to make a first impression on us right here.
Yeah, ChatGPT has a very mixed track record with getting this correct, and that is despite us spending hours working on this prompt to really get it in there. Okay, so let's see what this says. So revenue growth on a 3-year basis is 36%. That one's really easy.
I don't think that. Well, it depends. 3-year. I've got a Fiscal AI showing 19.5.
19.5. So over 20. So I would say that the color is pretty darn right? You can round that up to 20. But that number is wrong. So I don't know where it came up with this. Okay. Operating margin, 8.26%. That is positive and rising. So this interpretation is also wrong. Let's take a look at that operating margin. We want this number to be positive and rising. So operating margin is right here. That looks like a positive figure, and I don't know what's more rising than that.
Yep. That's good.
9.2% in the last 12 months. So it got
in fairness, we could be using thinking and have it take longer, and we might see if it does.
Fair enough. So this is green. This is green. Free cash flow margin. We want free cash flow to be positive and rising. So ChatGPT says 16%. So free cash flow, to find that, we're in Fiscal. We go to the ratios. We go to margins. And we go to free cash flow margin right there.
I think you're
and I'm guessing we see something similar.
Pretty good
17% free cash flow margin.
Yep.
For every $1 in sales, Uber is currently generating 17 cents of free cash flow. The average business in the S&P 500 is around 10, 11-ish. So Uber is already not twice, 50% more free cash flow per dollar of sales than the average business in the S&P 500. And this number is rising very nicely. So that is a green. So green so far. Earnings versus estimates. How does the company do versus earnings estimates? So to go here, we go to estimates. We go to quarterly, and we're going to go to earnings per share. And let's see. So the actual is 311.
That was a tax benefit, so
yeah,
it's kind
I
of
know,
a weird
tax
one.
benefit, but beat. I'm guessing that's also a tax benefit.
Yep.
Beat. But no matter how you shake it, the company has a history of exceeding estimates. And then finally, return on invested capital. We want this number to be, I think we just want it to be positive and rising, right?
Yeah.
Positive and rising. Is this number positive and rising? So if we go to financials, we can look at the absolute number, but I want to see the trend.
Yeah,
we
me
go to
too.
ratios, and then it should be under capital efficiency, return on invested capital.
It's looking
Woo!
good. Looking good.
Used to be negative. Now it's 23% return on invested capital. And boy, is that rising. So if we were to stop Skimify, I would go green, 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 green. That's pretty good.
Yep.
That is, I would say, would be pretty darn good.
Bruce agrees. Lovely.
Yeah. So the key metrics for this business look great.
Yeah.
Really great. All right, let's pause there. Do we have any questions that people have taken on so far?
No, I mean, we just have a lot of discussions back and forth about what's going on. You know, like Anu brings up, they're printing billions in profit off of subscription, like Uber One, buying stock back with it. I like this. It's not a no risk stock, but it's cheap with scale and leadership in a growing category. And he brings up a good point. I really appreciate this. The only reason you would shy away from Uber is because you think they won't be a player in autonomous. I think as far as an elevator pitch goes for what's going on with Uber, it's a pretty good one.
Pretty good. Yeah. Another thing to think about is, do you think autonomous is a threat to just the mobility, or do you think it's also a threat to Uber Eats and to Uber Freight?
I mean, I think Uber Freight I don't care about as much. I read this great piece in Stratechery that's what's his name?
Ben Thompson.
Ben Thompson. Also, just by the way, moved back to Wisconsin. And he talked about how he's long been a supporter, like a bull of Uber, especially back when everyone thought that they'd never be profitable. He was like, yes, they will be profitable. And he's admitted one of the things that he's not totally thinking about or considering is there could be with Tesla or Waymo an ancillary service where like you just have a car come and you put something in it and it takes it somewhere. So there's not even a person anymore. It's just, and that could capture a whole bunch, and Uber may or may not play a part in that. So it's a really interesting thought to consider.
I mean, that's going to be a big part of the thesis, but that would be a risk. And speaking of risks, that is the next section here that we're going to look at. So I have my risk analysis prompt. We're going to go to Gemini and we're going to say it to do a risk analysis for us. Now, as a reminder, there are, when it comes to risks, we want red, yellow, green, right? Green, no risk or low risk, red, high risk. When it comes to analyzing risk, we think there's 4 categories of risks you really need to focus on: concentration risk, disruption risk, outside forces risk, and competition risk. So that's what we've programmed into the AI. And then all of those sub risks boil up into one major risk, which is execution risk. So what are the things that could prevent Uber from achieving that 31% compound annual growth rate in earnings per share? If they can do that, the stock will probably do well. If they can't, for these reasons, who knows where the stock could go?
I have little doubt of what, in my mind, is the most important one.
Yeah. Okay. So using the 10K and the 10Q for the overall risk here is high. Outside forces, regulatory and labor, and disruption are the key risks. Offsetting that are network effects and a substantial competitive advantage. So concentration risk, no worries. 189 million monthly active users. No customer is more than 1% of revenue. No concentration risk. Disruption risk. Red. Identified threat of autonomous vehicles technology that could eliminate the need for current independent contractor model, requiring massive capital investment. And success of vertically integrated competitors in logistics could disrupt the asset-light model.
I mean,
Outside,
that's it.
That's it. Outside forces risk. The trend is flat and red. Regulatory and labor risk, ongoing legal and legislative challenges regarding driver classifications. Oh yeah, if they were classified as employees, that would be a big hit. And then economic inflation exposure, mobility and freight are sensitive to discretionary consumer spending. And then competition risk. It says red for that, huh? Operates in a duopolistic market, mobility versus Lyft and delivery versus DoorDash, and intense fragmented global markets requiring continuous spending on incentives and driver supply bonuses. And there's low barriers to entry. I disagree
I'd
with
say
this.
yellow for that. I don't think that we can forget about it. And I almost think that like the competition and the disruption can blend together a little bit almost too.
So I'll push back against this, though. It says low barriers to entry. No way. This is a very high barrier to entry company. Not because making the app is hard. There's barriers to scale, enormous barriers to scale, right? So I could start a mobility company. Nobody's going to use it, right? So
let me ask you this, though, because this is an idea I floated by you this past weekend. What if Elon's plan is, he doesn't have an app to get people like Uber? What if he just makes it so that if you're on X or Twitter, that's the app you use to hail your cab?
Yeah. If like we learned with Threads, right?
Yeah.
How do you start a no social network? You start with 1 billion users on Instagram and then you port them over to Threads, right? So how could Tesla really get mobility everywhere? They do have a couple 100 million monthly active users on X. And if you built that into the ride hailing app, I mean, that would be integration that Tesla shareholders like me would definitely love to see. But okay, now that we know all that, what do you guys think? Execution risk here. Is this a green, low execution risk company, yellow, moderate execution risk company, or red, high, very high execution risk company here? I would love to see what people think about that.
As that rolls in, it's kind of surprising now that I think about it that like Meta never came out with they have the billions of users. What's to stop them from having something like this? Maybe they just got better places for their.
Well, they kind of need a network first, and a car, a taxi network, and all that kind of stuff. Yeah. So and from Google does have how many products that have 1 billion users, especially Google Maps.
Yeah.
Wow, if they can integrate Waymo with Google Maps, which I'm sure that they can.
Look at Sean's asking the $1 million question here.
Yeah. If you ask Elon, the map is 6 months.
Yeah.
Right. If you go to really things, but the thing with disruption, if this is a disruptive if this truly is disruptive, it's going to be imperceptible, and very small at first. Uber could probably still grow, and then it could get wider. But here's the thing I learned from Tony Seba. There's a big difference between a market, a company being disrupted, and its stock price being disrupted. Huge difference, right? You could have if growth in Uber slowed and the markets whiffed that is due to autonomy, even if growth just slowed, the market is forward looking. The stock could tank, absolutely tank. The market could say this is a stage 6 company. Yep. And if that happens, it'll value it at like a few times earnings, right? Yep. So there could be a massive pullback in the stock well before Uber, the business, was disrupted. If you want to see that in action, go look at Radio Shack's stock, or Bed Bath & Beyond's stock, or any failed company recently. Their stocks cratered years
even
before
though the business didn't look that bad. Even though the business didn't look that bad.
Correct. Correct. So if the
Because
market
we're
can
looking
sniff
forward.
out, if the market sniffs out, no, this is a major, major problem, the sentiment goes to zero and the stock just gets hammered and the valuation won't matter. So what do you say, Brad? What was your feeling for the risk here for company? What do people say?
Other people, I would say the average is yellow, but there was a lot of reds.
Yep. I would personally say red. I would personally say red. I think that they have a lot to. I think that they have a lot of irons on the fire, and they have the major threat that they have to think about. Well, they have to think about competition here is real for each of their individual segments, and they have to worry about pricing. But managing a platform shift to autonomous, that is not going to be easy. That it's just not going to be easy. So I'm not saying they can't do it. I'm just saying it takes a high level of execution to do it.
Here's my thing too that we haven't talked about because we're focused on Uber here. We're not focused on Tesla, but I do think it's worth addressing. So I've done a lot of research, just kind of not a lot, but I've done some research on just Tesla can produce that cyber taxi at a lower cost than anyone else can produce an autonomous taxi. Like
that we're aware of.
There's probably players in China that can do it. And actually, I forget who it is that I think Waymo recently partnered with a Chinese automaker to test in certain cities because of this very reason. But the bottom line is we're talking about Waymo partnering with the Chinese automaker. We're talking about Tesla being vertically integrated. And if you can put those cars on the road, if you can put the cars on the road for less, then that can lead to cheaper prices, and cheaper prices can lead to winner take most dynamics. But number two is that let's just say that Elon uses X, and that X thing on your phone becomes your ride hailing app. Mm-hmm. And you can have people that own their own Tesla kind of be there to offer more supply during rush hour because they'll get paid for letting their Tesla go off and transport people. That solves the size of the fleet problem that Uber doesn't have to worry about because they've got all these free cars. They don't pay for the cars, but Tesla does have to worry about. So there's a lot of variables that we're talking about here.
So what you're saying is the execution risk is high.
Oh, absolutely. Absolutely.
Yeah. And again, that doesn't mean that it's not going to happen. It just means it takes a very high level of execution to pull off this transition. Very high level of execution. So the execution risk, I think it's safe to say is very high. And Stock Simplifier, if you're watching and are interested, it's $99 using the link that Stoffel will share. Lastly, valuation. What is this company's valuation? So we know that it's in phase 4. And when it comes to phase 4, the primary tool we're going to use is the forward price to earnings ratio and the forward price to free cash flow ratio. Now, if you looked at my emails that I sent out to this, we did note that right now, Uber has a very high negative tax bill that's boosting its earnings per share. One reason that I like using forward PE ratios better than trailing is forward PE ratios kind of eliminate that as a problem. So here is the forward price 27? To earnings ratio. Yep. So can you tell when they became profitable? Yeah. So the PE ratio, we'll forward that to 2023. Okay. I'm guessing that there's another
tax. I mean, we saw the other tax benefit they got.
Yeah, that makes sense, right? So the tax bill got kind of whacked here. So eliminate this kind of from your mind. Like this is probably the real low. So currently trading at 27 times next year's earnings estimate. So looking forward, 27 times forward earnings. And if I click this little graphing line here, we can kind of see the average high and the low. That average is probably skewed from,
although it's median, so it's not too bad. It's not the mean, it's the median.
Yep, that is true. So slightly below the median. All right, now let's look at forward price to free cash flow, and 18 times price to free cash flow. Let's get some indicators on there. That makes it easier to see. So the average has been about 19 times forward free cash flow. Is currently about 18.6 times. We might be able to scoot this one back a little bit. Yeah, we can. Yeah. So because we have Uber became free cash flow positive. Okay, so what's that, about May of 2022? So we'll go there. This I would say is a more meaningful chart than we saw. So kind of
I would
the
say that it's
high,
like 5 to 10% undervalued based on the median.
yeah. So high, 30 times price to free cash flow in 2023. Low, and again, this is actual cash. So low of about 11 times. Currently about 18 times. So what do people think here? What do you think that this company's valuation is attractive? Red, unattractive, overvalued. Yellow, fairly valued. Green, undervalued today. Would love to know what people think about the valuation here. So we did execution risk there. So forward price to earnings and forward price to free cash flow. What are people saying still?
All right, so we've got a yellow from Cass and David, a red from Robert, yellows from Ronald and Karsten. Jack gives it a yellow, a red from Tariq, yellow. We got Robert. I like this. Green for maybe the next 6 months. Luella went off the charts and went mango. And then a couple more yellows, a yellow green from Scott, a yellow from Tony. Mahendra gives it a yellow. Yeah.
Great. All right. Final boss question. So let's review that we learned. So this is a company that was an exciting business. It has a moderate moat, a decent sized moat, great long-term potential. It aced the key metrics test. It does have very high execution risk, especially with that autonomy, and it's moderately valued today. It's fairly valued today. So red, yellow, or green. Red, forget this company forever. Yellow, I'm kind of interested, maybe put it on my watch list. Green, I want to buy stocks. I want to buy the stock today. What do people think of Uber, the investment, on December 9th of 2025?
Tariq says, given the risk, I want a larger margin of safety. So value.
I would say that's a pretty darn good. That's a pretty darn good takeaway. Yep, David says green. Buy today. Nick, green. Excellent business, but high valuation because of the key metrics. Yes, yep. Green. Okay.
I'd say the big thing to remember is key metrics look backwards. Yep. But they are great.
They do look great. Yep. Risk is too existential. Not interested, but I love the analysis framework. Awesome. Thank you. Thank you for watching. Hopefully this was a useful analysis to see how we look at business. All right. So what would you say is the overall?
I think yellow is the overall.
Yeah. So there are some people here saying, yes, I totally understand why. There are some people saying here red. Did you get any reds?
Yeah, Luella had red.
Okay. Yeah. For me, this is for me personally, this is on my no list. If this company successfully bridges the gap to autonomy, count me in. Mm-hmm. Like this is a just sensational business, and I know the new CEO is really good as well. But that is a mega risk that I think investors are taking on. And as I said previously, if the market sniffs out that it is in a position to lose autonomy, and that could be years before the data actually shows up and really impacts the company's numbers, look out below. The sentiment on this company could fall, and this stock could get absolutely hammered.
And I'll throw out there, it's going to look like a freaking steal.
Yep.
If that happens, because business will not disappear overnight.
Right.
But the valuation could.
Yeah. When companies are being disrupted, and the market sniffs that out, it bids down the stock price so much that you look and the PE ratio goes to like 3, right? And you're like, oh my God, the company's buyback yield is 15%. But a very low valuation and debt is actually a very dangerous combination. But if your core business is truly disrupted, your business is going to zero. And you can't overcome that. Your business is going to zero. And doesn't matter how low of a valuation you pay. If the ultimate price you hold towards is 0, you're going to lose money.
Yep.
That's just like
I appreciate this. That Robert says this is a great company to evaluate the efficacy of these prompts, because I think the prompts did
their job.
A pretty good job. There is that one that always gives us some trouble, but so I just want to reiterate that if folks want this, then you can head on over, use that link that we're putting in to get Stock Simplifier. And all future updates to the prompts that we make, you have access to as well.
We have some exciting things going on with Stock Simplifier that we
Just a
think are going to
few.
make it even better. So just keep an eye on that. But we love this tool and analysis framework, and we want to make it as easy as possible for people to use. So we will continue to upgrade that and let people know what's kind of happening there. So as a reminder, with Stock Simplifier, if anything we said in this video, you're like, what does that mean? Why are they looking at that? It's in the entire course that comes with Stock Simplifier. You also get the spreadsheet tool that kind of walks you through everything step by step. You get all of the prompts, including that new sentiment analysis prompt. It's $99 if you use the link that Stoffel did provide there. And with that, we would love to know your opinion. What stock do you want us to research using Stock Simplifier next? There are so many great stocks out there. At this point, we've done the Magnificent Seven in the last 3 months. So we've done Tesla, we've done Apple, Amazon, we've done NVIDIA and all that kind of stuff. I've seen some great suggestions in the past, so please put them in the chat if you want us to look at companies there.
I want to thank Luella, who he has continued to use this. We got a lot of Airbnb suggestions. We got PayPal. We've got Lululemon. We got Sprouts Farmers Markets.
I don't think I've ever looked at Sprouts Farmers Market, so that would be an interesting one. I do know it's been a great business. Shopify, that's a good one. Copart and stuff. And as a reminder, the next time we're going to do this webinar in this series is in 2 weeks, December 23rd. We will do that, and on Wednesday the 17th, so 8 days from today, in our newsletter, we're going to put 4 companies on the list for people to vote on. But next week, Stoffel, you and I will be live Tuesday, 12 o'clock, same time, same social channels. And what are we going to talk about next Tuesday?
We're going to be talking about doing a reverse discounted cash flow analysis, because everybody sees us do this. That's beyond just Stock Simplifier. This is like the next level up. We're going to be covering that, and so you can see how we use this tool for free next week.
And why are we doing that as a topic?
Because it was the #1 request at our last webinar that we did.
Yep. So the general cadence is every other week, we're going to do a stock deep dive with Stock Simplifier, and then we're going to do a broad-based investing lesson. We have ideas for lessons on valuation, on Moat analysis, deep dive into Moat analysis. But the #1 request we got last time we did this was, how do you use a reverse discounted cash flow calculator? So that's what we're going to talk about next Tuesday. The Tuesday after that, we're going to do another Stock Simplifier deep dive. So Tuesdays at 12 o'clock, Stoffel and I are going to be here live, and we would love it if you guys could join us every week on Tuesday. So thank you guys. What's this question?
One quick question about Stock Simplifier. Do they get updates to the process, like the prompts or new prompts?
Yes, absolutely. As we update Stock Simplifier, people that already bought Stock Simplifier will get the updates. Yes.
There we go.
Yep.
All right.
And reverse discounted cash flow calculator. Yep. I hope I get an invite for next week. Absolutely. So thank you guys so much for spending an hour with us. We super appreciate it, and we hope you spend time with us in the future. If you have topic suggestions, if you have stock suggestions, email us. Put it in the chat below. We are happy to take suggestions. But with that, that's Brian's out.